Good morning, everybody. Welcome to the Trust Engine Mortgage Coach weekly mastermind. Todd Bookspan I'm not sure exactly what Todd's doing, but I know he can't be here today. So I've got one what do we call it? Wingwoman, Deborah Bird. What's up, Deborah?
Hello. And in honor of Todd Bookspan, I'm wearing his gear. I've been wearing my shirts lately of the No Borrower Left Behind. So make sure y'all check out the Win by Noon shop. And then also we have just 3 spots left of our Phoenix Exactly What to Say personal certification, which is next month. So if you are interested in that, just visit toddbookspan.me and we'll get you in the group.
All right, so we will have Dan here any minute. Dan Rawitch is going to let us know what he thinks interest rates are going to be doing short-term, long-term, give us a market update so that everyone will have some new slides, you'll have some new talking points, and you'll be able to show up at real estate meetings with a higher level of confidence and the ability to deliver more value. Just, in the spirit of not burning time, but trying to get Dan on here, I would love to know what people think are going to be what the interest rate's going to be middle of December. So as we're closing out the year, if you had a guess an interest rate on the 15th of December, what would it be? So David Allen thinks it could be closer to 6.
The other thing I was going to hit on is this is the last Friday for August. So August ends next week. Fun fact, the Nerd and Bird turn 40 next week. So we are going to Miami, but I'm curious if any of you, what are some of your daily habits or even end of month habits as we end kind of the peak of home buying season? So typically the end of August is when we start to see some of that fall seasonal, pullback. And also make a note of that we have to really be careful of the media. And we know the media sells fear, but what do you have in your arsenal and what is your plan, even from a content strategy standpoint, of how to combat almost the headlines where we're going to see things like, home prices are falling and kind of that doom and gloom, which they typically do come the fall and the winter. Also be on the lookout of seeing media stating that, the rise of foreclosures, and compared to 2 years ago, how much higher foreclosures are. Again, be careful with that and make sure that you're creating messages out there to debunk the fact that we couldn't even foreclose on properties 2 years ago. So I just want to bring that up as we wrap up the end of August, that we are, a month away from hitting Q4. And so what is your plan? What are some of the new activities that you're going to double down on, or new standards? As sometimes the fall we kind of pull back a bit, but this might be when you need to hit the full court press even harder.
So Dan, let's get right into your update. Feel free to share your screen anytime. Folks, if you have questions for Dan, let us know what they are, and let's rock it out.
All right, let's get this PowerPoint open. So again, Dave, I'm really sorry, and Deborah, I know how stressful that is to not have the guests
good,
there
Dan.
when they're supposed to be.
It was fun.
I know. Oh my God, it stressed me out. I have this weird thing about being late. It just, especially when lots of people waiting for you. Okay, enough about that. So I didn't get to. I heard Dave ask the question. I didn't get to see the results on the interest rate guesses. But for now, I wanted to kind of bring you back to probably my last 2 updates. And some of you probably are sitting here fuming, going, is this guy ever going to be right? Well, let me remind you, even a broken watch is right twice a day. Eventually, I'll be right. So just wait. That was a joke. But as you know, I've been saying for quite some time, I haven't forgotten that the third or fourth quarter, we should see a significant drop in rates. And I think I'm gonna do something unusual. I'm gonna go right to one of the last slides I was gonna show you, just to make this point right now. And then I'm gonna go through some of the reasons why I'm still extremely passionate about my prediction. So first of all, let me just bring up a chart here.
And for anyone that's not following, like, I don't know if you want to not just assume everyone knows what you're referring to, because some of it, we've got new people watching this video. If you might want to give a little backstory to that.
Yeah, sorry. Yes. So, Dave is kind enough to have me on these calls. I'd say almost on a quarterly basis. And I know, God bless him, he'd let me on more if I asked. So, the theme for some time has been how long can these rates stay higher? And when I gave my last update, well, it's been very constant. Each update, what I've been sharing with you guys is that the economy is not great, in spite of a lot of things that were being shown. I'm going to show you a bunch of things that will kind of argue at that point. And inflation has been dropping like a rock for several months now. And my belief has been that either we go into a recession or we get darn close in the third or fourth quarter. And the Fed, as always, as far back as I can see, is behind the times. They will react as if inflation hasn't dropped. And then all of a sudden we're going to recession and the Fed wakes up and says, oh, I guess I should have dropped these sooner. And then they slam them down in ways that you probably can't even believe right now. But let me show you something. This is pretty important. So first of all, notice this level we're at right now. This yellow line is at about 4.3. We touched it. We actually got a little bit beyond it. Now look at what happened the last time we touched it. That was October of 22. And we were at 4.32 in October of 22. And then by December of 22, we were at 3.39. So that was 1%, guys, in 1.5 months. And then we continued this downward fall to 3.25. So this is a tiny example of the point I'm going to make for you. Just want to remind you. And by the way, we did form this kind of double top. So there's a little bit of risk here with a double top always. If you break through, the lip of the former top, things can run. So I'll get more specific here in a minute, but let me kind of scrunch this up and move back.
And you're going to share your slides, Dan. We'll get those into the Trust Engine Productivity Mastermind Facebook group, and we'll also have a link to them. If you're watching this in YouTube, there'll be a link to Dan's slides that he's going to walk us through.
Yes, sir. So let's talk about the Great Recession. So, around 07, things really started getting ugly. Why did they get ugly? Well, because the Fed did this. The Fed started, in around 05. These were, if any of you were in the business during this period, these were some of the best years of your life. But it wasn't sustainable because, we were making no money down loans down to 580 credit. I mean, I was really ready to release a stated FICO program, and that's how bad it got. So the Fed starts seeing that the economy is heating up. It wasn't heating up. And even though it was doing okay, inflation was extremely low. But the Fed starts raising, and we go from 3.79, which at that time seemed very low, and he takes us up to 5.24. So 1.5% in a very, very short time. And then the recession hits up here, and he is in panic mode, and he is just pushing these things down as fast as he can. And then something magic happens when we come through this 4.32 level. Mind you, this is a level I showed you in current time. This is what we touched. This is where that double top was. But now I'm showing you how reactive that level was in 06, 05, 03. This is a really major level. And when we came through it while in recession, we were at 4.33 in November of 07. by March of 08, 3.3. So what is that? A 2.2% drop, guys. 2% right now would put us down in the twos. And then things spike back up and they touch, guess what? Magic level 4.32. This is June of 08. And then it gets really interesting. By December of 08, like, what is that? 5 to 6 months later, we hit 2%. Rates fell 350 basis points. And then, you know, they bounce around. And the point I'm trying to make to you right now is how fast things change when the Fed realizes that he's not that smart. So April of 10, we're at 4. And October of 10, we're back at 2.31. And then February of 11, we're back at 3.7. And by September, 9 months later, we're at 1.66. So, wow. And it continued to fall, of course, until 2012, which was an incredible year for the industry. We hit 1.42. And this continues to happen even in much more recent times. In January 14, we're at 3. And in February of 15, we're at 1.5. And last but not least, November of 18, we're back to 3.25. We got really close to my yellow line here. It doesn't look close, but it actually is. It's 1%. 3.25, November of 18. September of 19, 1.47. And March of 20, of course, 0.4. So when things begin to crumble, they crumble very quickly. So you may be sitting back going, well, he said this was going to happen third and fourth quarter. It can't happen now. It's too late. That's not true. This really can still and probably will happen this year. There's a couple things technically can actually get boring if you're not a student of this stuff or you don't have a huge interest of it, but to just try to simplify. One concern I have, I did not want to do that. Let's see, I think I know where that goes. Yeah, right there. So this big channel here with red on top, green on bottom, this is called a regression channel. And the middle of this channel, the whole idea with a regression concept is that you have the mean. This is the mean price. This is where price wants to be. And you'll see that it's always driven to the middle of this channel, always. We make money trading this. When it hits the outside, we know it's going down here and probably to here. And then my system gives us sell signal and it makes this a great trade. So right now we are up against the middle of the big channel. That's good because it's very unlikely that it's going to come through here. But also see this little guy here. This is a little more reactive channel that we use. And look at how perfectly we go up and down and up and down and up and down. We've been staying, in here. Now we're at the top of the little guy and the middle of the big guy. So it will bounce for sure. I'm very confident of that. And it's going to come down to here. That's not a lot. What we need to have happen is it needs to break through this little guy and then it'll absolutely 100% come down here. In fact, when price crosses the blue line, there's an 80% chance it's going to make it to the other side. And when price decides to go back to the mean, once it begins its journey, 80% chance it's going to get to the other side. Now, once it hits the middle, it's 50-50. So that kind of brings you where we are now. I expect a move in the shorter run down to about 4.05. I don't know what Powell's going to say today. The thing about what I do is we're influenced by two things. One, of course, is the bond market, what's going on. And the bond market's influenced by what we call fundamentals. That would be Powell speaking, that would be all the economic releases we speak about, inflation, all that stuff. That's a huge driver, but it's only half. The other half is the charts. And you have people that believe it's all technical, the charts, and you have people that believe it's all fundamental. And I think for 15 years, I've been passionate about telling you it's both. Look, Powell could say the wrong thing today and wreck this chart, like this whole double top concept right up. And he's been really good about doing that. He does it all the time. Every time he opens his mouth, he wrecks my chart. So, but then next week, we're going to get some inflation numbers. We're going to get payroll numbers. And then if the chart is in a position where it's ready to fall, and then it gets some news to nudge it, it'll come down pretty hard. So with all that said, let's just kind of quickly look through some current economic slides.
Hey, so Dan, whether you answer this question now or you wait, you say, hey, Dave, let's just wait and answer that at the end. I do want to get, if you had a prediction of what rates would be in, middle of December, what's the Dan Rawitch guess? Do you want to do that? Take a swipe at that now, or you want to wait until you've shared some of this?
Yeah, no, let's do it now. I'm still pretty confident that we're going to see rates in the twos. Whereas last time I spoke,
But what will mortgage interest rates will be at? What will mortgage?
More. Well, there's a historic spread between mortgage rates and the 10-year bond, and it's kind of in the 2.5% range. So that should put mortgage rates back down into the high 4s, low 5s.
So you still think you're hanging on to the thought that rates, first of all, needless to say, directionally, they're going to go down between now and the end of the year. Like, that's bet number one. And you think the target, there is still hope for low 5s, high 4s by the end of the year. You still believe that?
I do. And again, I'll go back to where I started.
So by the way, guys, everyone watch this. Do we like that? Let me know with a little reaction if that would be good news for everyone. All right.
Yeah. So just a quick reminder, we touched this level in 08, exactly where we're at. Actually, let's see, so this was kind of June 20th of 08. And then by December of 08. So was that 5 months? We went down to 2% from 4.31, 3 months. Okay. Or no, cool. Sorry, so 6 months. There's time for this to happen. Yeah.
Okay. What can make me? You and every mortgage professional, executive or in the trenches, would love for this to happen. So I hope it does.
Me too.
So now show us some slides on how this all works.
Yeah, let's go through this and I'll talk about what could make me wrong. So this is a good news and bad news. This is literally the most anticipated recession in the history of mankind. Going back to 68, and we can go way back. Never has there been more anticipation about a recession. Now, I'm a contrarian. I hate this. The math is always wrong. So when I see this many people thinking something's going to happen, even though I really also agree with them, because I'm not a contrarian because it's fun. It's just, I think I've told a lot of you guys, my very first semester in business school, the instructor, before he even said his name, nothing. He had his back. This is one of those seminar type classes with probably 300 people in it. And he writes in big letters. You don't even know what he's writing, but he's writing really big and furiously. And we're thinking, this guy's going to be weird. And he turns around and he screams, the math is always wrong. If you want to be poor or average, just follow the math. If you want to be rich, go against them. And I never forgot that. And I suppose it made me a contrarian. So this is a dilemma for me. The mass is kind of believing there's going to be a recession. Now, you can look and see, how does the mass do actually in this particular category? Well, the mass started feeling strongly about a recession, and we got one. And by the way, these recessionary feelings began way before COVID. It was COVID that actually got us there. Again, the mass starts feeling pretty strongly right into a recession. Here the mass couldn't have been more wrong. They're actually saying no recession, whoopsie, and then no recession, whoopsie. So you have this kind of mixed bag, but for the most part, when the math says there's not going to be a recession, there's a recession. But more recently, I would say that we're getting better, and by the way, this mass is not like John Doe or John homeowner. This is actually, analysts and economists when I'm talking about the mass. This is the Fed survey of professional forecasters. So you can see the pros get it wrong quite a bit. But now, why? Why would we have a recession? Well, number one, this is the index of leading economic indicators going back to the 70s. How many times has it gotten near this red line or past it? 1, 2, 3, 4, 5, 6, 7 times in 50 years. So not a line that gets touched a lot. Well, we're all over it right now. I see nothing going on that would stop this from crossing the line. And remember, well, we talked a lot in the past about yield curves, and a yield curve quite simply is, visualize this with me. Here you have a 1-month treasury bill, and here, I forget what's really on here. Here you have a 1-month treasury bill, and here you have a 30-year bond. And then the 1 month historically might be 0.5%, and the 5-year might be up here at whatever, 2%, and then 4, etc. So that's a yield curve. Right now, the yield curve is going this way. It's inverted. It's not supposed to go this way. So it'll go this way. So every time in history, well, maybe not in history, for sure, the last 7 recessions were preceded by an inverted yield curve. So why would short-term rates be higher than long-term rates? That's not logical to our minds as we've grown up, because the investors, this would be the smart money, believes that over time rates are going to drop. It's a very clear message that things really are not great, and that the long end of the curve, it needs to go this way, not this way. So an inverted yield curve has always led to a recession. Okay, M2. M2 is the measure of money, savings accounts, checking accounts, money market funds, etc. So most of the money in circulation is caught by M2. The money supply got out of control. It hit all-time highs. This goes back to 59. Why? The Fed kept pumping money into the system, creating this stimulus. And so it flooded bank accounts and checking accounts and all that stuff. Since that happened, the money supply has been dropping like a rock. Now, if you look at GDP, for those of you that don't know, GDP is the measure of our income. This is like a P&L for the country. It's all the goods and services that are created in the country. And you can see that generally speaking, as M2 has risen, it's taken GDP up, but not like it used to. The point though here is that look at what happened to M2. The Fed's just killing it. Sorry, I pointed this at M2. This is actually GDP. So as the money supply goes down, so does the economy. And the Fed keeps pushing this down. Literally on almost a weekly basis, I'm watching M2 fall, and I know that that's going to continue to crush GDP. When GDP goes negative, that's a recession. This is what happened to GDP during the pandemic shutdown. This is what happened to GDP during the Great Recession. This is where GDP ended up last year. This number was part of why we had inflation, because the Fed stimulated the economy, flooded it with money, and all the CARES Act and the Hero Bill and QE and all that stuff. It did increase GDP, but in this particular case, it created inflation. I'm going to go to stand by for this point. I want to talk more about this, but so now all of a sudden, the experts are telling us that GDP is going to hit 2.22 this year. I don't quite understand how the leading economic indicators could be, at historic lows. I don't think I have a slide for this, but U.S. savings rate are at an all-time low, and personal credit card debt is at an all-time high. It's not a good mixture. Like, how would you feel, at your home? If your credit card debt has never been higher ever, and you have no money in the bank, your savings have just been depleted. That's not a good feeling. That's not a family that's going to go out and buy cars. That's a family, unfortunately, that the school closed this year coming from Target, not Nordstrom's. These things really start taking a toll. I don't understand how this can be 2.22. We'll see. The deficit's still growing. The Fed keeps spending money, even though we're supposed to be choking off the economy. Yeah, he has shrunken M2, but yet we're still seeing this stimulus spending. Most recently, the Inflation Reduction Act, non-political, but yay, good job, guys. Like this was passed when inflation was nearing its all-time high. And the government, so the black line is GDP. Remember, call that the income of the country. And this orangey line is how much the Fed is spending. And remember, always think of spending as debt, because when the Fed spends money, they create debt, and that's how they put cash into the system. We always talk about the Fed's printing press and they're printing money, blah, 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 but they're not. They're creating new debt. And that's how the money is born. And in the past, there was a time where the more the Fed spent, the more the GDP went up. And when the Fed's not spending, GDP is going down. What does this tell you? This tells you the economy left to its own can't grow. When the Fed's spending money, it can grow. And when the Fed's not spending money, it shrinks. The Fed is really just about out of spending power here. And that's going to also take GDP down. Remember, GDP going down is equal to the Fed being in big trouble and having to fix that. And the way the Fed fixes that is by interest rates, lowering them. Our income not so good. Federal receipts, this is taxes collected. This is like what you bring home with your paycheck, or if you own a company, these are your profits. Well, the Fed's receipts, wow. What does that tell you? The Fed's not collecting tax dollars. Tells me that there's not enough income to create tax dollars for the Fed. And of course, you can see that when the Fed receipts go down, of course, GDP is going to go down. But look at how far ahead the drop in tax receipts is from the GDP number. Normally, the GDP number is much closer. So you have a ways to fall here. This is where we're a little out of step. This is the Fed's fantasy world, seeing that inflation could continue to rise. It's coming down. It's not going up. Now, where could I be wrong? If inflation makes me a liar, reverts, and starts going up again, I'm wrong. I'm wrong about every single thing that I said. So there's always this thing when we're making these forecasts, they're always dependent on a certain fact set. And by the way, anytime you're talking to somebody and they start spewing, oh, rates are going to do this, or rates are going to do that, ask them why. Why do you believe that? Because that's really what the discussion should be. The discussion is not your opinion. I don't care about your opinion. You shouldn't care about my opinion. You should care about what's driving my opinion. And we should debate the drivers. Does that make sense? So if I say rates are going to go to 2, yeah, then I'm depending on inflation doing a certain thing. I could be wrong about inflation.
Hey, Dan, real quick, I always like to get simple formulas, like how do we take, what are the 3 data points that are most cornerstone to your take. And, clearly inflation is kind of the North Star. But if there were a couple other, indicators that you think create the formula based on your opinion, what are the other two?
So that's a great question. But let's elaborate on inflation for a second, because it is the North Star. It is the everything star. So when we want to debate inflation, then we have to debate the drivers of inflation. And what are those drivers? So great timing for the question too. And I'll go deeper into that question in a second, but we're staring at this slide. And what the slide is telling you is that 44% of CPI is housing. So don't you think that housing's going up as much as it has kind of done something with inflation? And shelter is 34, which is, rents. Rent a primary residence. So if you think these numbers are going to climb, then that could have an effect on inflation. Some of the things that we're really feeling is food, but as much as you feel it at the grocery store,
how does shelter at 34% look different than owner's equivalent rent of residence, which is at 25? Like how are these all different, or are they built into it?
Yeah, this is like a cumulative number. And so this would be lodging away from home, lodging from hotels.
Okay. I get it.
Equivalent of rent. Yeah. And then the blue stuff is housing, just rent of primary residence, et cetera. So they're very similar, but they're slightly different. But that's a huge driver of inflation. Fuel and utilities, it's been painful. But again, even if it really shoots up, it's not going to be a huge driver to CPI. So what are the drivers? How do I want to say this? So when I think about the drivers to inflation, I think about Fed stimulus. But here's the deal. And over the years, I've shown tons of slides that will show you that regardless of how much money the Fed put into the economy, they did not raise inflation, nor did they move the economy. If you go back into the 70s, 80s, 90s, for every dollar of stimulus spent by the Fed, we had a dollar of economic growth. And then somewhere around mid 90s, we crossed this chasm. And now it takes $17 of Fed spending to get $1 of growth. So the Fed just keeps trying over and over, just pumping money into the system, and they can't make it grow. But because they can't make it grow, we're not seeing inflation. So where does inflation come from? If you think about Milton Friedman, he said that inflation is too many dollars chasing too few goods. Makes sense, right? Think about housing. You have all these buyers, and then you don't have enough housing. That's the definition. So what happened with the pandemic? The Fed flooded people with money more so than we've ever seen in history. And then we shut down their ability to buy anything. Now we have a historic amount of money chasing no goods. Nothing. Remember, there was nothing. Production was shut down. Remember, shipping, the shipping costs went through the roof. It was taking months to get a ship out of the sea onto the dock. We just couldn't catch up. So there was way too much money chasing zero goods. That was the perfect storm. I'm telling you, if you had only the Fed pumping people with money and you didn't shut things down, I don't think you would have had inflation. Because again, I've gone back to the Depression and I've proven Fed spending does not create inflation, but Fed spending too much with no goods will do it. So I think we've kind of gone through this once in a lifetime situation. Not that inflation hasn't been higher before, because it has, but I'm talking about, let's say, this generation. I mean, my God, I'm old now. And when the last time we had inflation, I was like in my 20s. So, okay. So this is kind of an idea of what's been happening year over year with shelter. And we talked about shelter being a really big component of inflation. And you can see it's pretty much all negative here. So unless you believe suddenly rents are going to turn around and housing prices are going to go nuts, inflation will continue to come down. So back to your question. So the people believe the drivers to inflation are the job market, GDP, which comes from, a robust job market, and of course, what the Fed is doing. So, and I just believe that we can have a job market, we can have sub 5% unemployment and not have inflation. Look back in history. It's happened over and over and over. I believe that GDP can hit 5-6% and we won't have inflation. And again, I showed you slides that showed you that. So inflation is just kind of a weird thing. And in my opinion, it takes a perfect storm to create it. And I don't see anything in the horizon to make it jump again. Something could come up that I don't know about, and then I'll be back on this call apologizing maybe in the fourth quarter. Because I do, unlike a lot of prognosticators, I remember what I said. Sometimes I wish I could forget. I always wish you could forget, but I do remember.
All right.
So here's your month over month.
Well,
Did you have a
Dan,
question?
so
Sorry, Dave.
yeah, so you've given everybody your prediction. The headline was, what do you think rates are going to be? Check. You're going through some slides and making the case. And by the way, we've got 20 minutes left, so you could continue to do that for 20 minutes. But I also, if either you could do that within the next 20 minutes, I want to if loan officers are talking to realtors and homebuyers, what should they be telling them? And if there were a couple slides that they should be using within their conversations, I want to know which one you think those are. So if you could just think about that as you're going through the next few slides, that we net out those two things.
Okay. Yeah, that's a good question too. This is monthly and year over year CPI shelter. Remember, that was the big component of CPI. And you know what happened after the pandemic. This didn't happen before the pandemic, and this didn't happen it just didn't happen before. Look what was happening since 2019. And then the pandemic came. That's what did this, period. So I do believe this will continue its course down. And this is already a decent move. This was shocking, actually. This slide took me by surprise. New housing starts are 60% below 2019. And I've always said, builders are psychic. I don't know how they do it, but I've always watched the construction industry. And every time I've ever seen the builders pull back, bad things have followed. Economically, not for rates. So this was a stunning figure, 60% drop in housing starts. What are they seeing that we're not? This is CPI when you pull out shelter prices, and you can see the CPI without shelter is all the way down here, close to 0%. And then CPI, this is month over month changes. So it didn't grow. If you take shelter out, CPI did grow a tiny bit, but it's since stabilized with shelter. But look at this number compared to this number, and think about where rates are now compared to here. Rates are a lot higher than they were when this stuff happened. But the Fed just kept raising rates, even though this kept coming down. And there's a point where it's really going to smack them in the face. And I think we're pretty close to that point. This is kind of a blown up version of what I just said. It's year over year CPI here, and then without shelter. So big difference, like 2.5 to almost 0. All right, this is really interesting to me. This is China's near record low 10-year bond. Think about that for just a minute, okay? We're at near record highs and China's at near record lows. We are a global economy. As China goes, we go. As we go, China goes. This was really staggering to me. And I have never seen a spread anything near what we have now between our interest rates and China's. I mean, we're almost double theirs. Well, not double, but 180 basis points higher than China. Come on. More than anything, this slide should leave an impression. This is one I probably would show.
It would be interesting to see
a
a slide that overlays ours with theirs. So, that historic gap is more clear. I wonder if there's anything like that out there.
Well, it's not hard. Like, so here's April of 20th, China was at 2%. And our April 20th, was that April 20 of, sorry. That was April of 20, right? Yeah. So our April of 20, March, May, April. So our April of 20 was 0.6. Theirs was 2. We were 140 basis points lower than them. And see that? 2.57. We're at 4.3. Back here, they're at 2. We are at 0.6. So we have historically run much lower than China. And you can see now we're much higher than China. This reversal doesn't make a whole bunch of sense. And then I think this slide's pretty good, but it's just a small part of the picture. That's why I went to the actual chart so you could really get a feel. But this shows you in 08 how we touched this 4.32. That's where we are now. This is where we're in 08. And you can see what happened not that long after. This was 08 to 09, from 4.3 to about 1.8. It's a big difference. So I think now this is a tricky, slippery slope, right? As loan officers and real estate agents, our job is to create urgency, to make sure that people want to buy now. And this is probably not going to do the trick. But what I would tell anybody is if you want to wait until rates come down here again, okay, be prepared to pay a whole bunch more for houses and be prepared to wait in line to buy a house versus
the
buying
thesis,
now, refining.
So the thesis to buy now with your projections of lower interest rates, it's like it is time. And if what you say is true, next spring home buying season, it's going to be just a different marketplace for a buyer. Like this is absolutely the best time to buy in the Dan Rawitch paradigm.
Yeah, unless you're in a vacuum only looking at interest rates. Then
If you were
it's the worst time to buy.
Yeah, and if you could only show, and maybe it's an unreasonable ask, 2 slides, 2 data points that draw to that conclusion. I mean, maybe you need 5, but if there were 2, what would the 2 biggest data points be?
And the question is buying now?
Yeah, the buy now.
Talking about?
Yep.
Okay. Again, this is like perception. If a buyer is really like hell bent on lower rates, then this would tell them to wait. But if they're thinking about the whole picture, this would tell them to
But
buy
they can buy now and date the rate, marry the house.
Refi. Yeah.
Yeah.
I did
date
that.
the rate, marry the house.
I bought a house in November. We spent 5 years living full-time in our RV. And I was very content to not, I mean, we owned some property, but I didn't own a personal residence. And we're just so happy. And I don't love my 7% rate, but I know it's a very short-lived, and I know I could never buy this property that I bought again for anywhere near this price. So yeah, I'll think about a couple other slides.
Yeah, think about a couple of slides, and then also, we're at the 10-minute mark. We got 2 minutes left. Deborah, is there anything you want to, ask Dan, or some color you want to create? Because our goal, like we want to give the update, make people smarter, and then if there's something that they can use on social media, if there's something they can use at a realtor meeting, anything you want to ask or say before Dan does this next round?
Well, I do have the same question that John just put in the chat around the housing starts, Dan. So he said, why would housing starts be down with inventory at historical low rates? Is there anything, like, what are they wary of? Wouldn't you think that the start should be going up?
Yeah. That's
From
the
20,
question, right? I agree with John. I do think they were going to that slide was stunning to me. It means in spite of historically low inventory, the builders are seeing things happening, and I'd have to dig deeper to find out what are they seeing. Obviously, it starts with traffic in their open houses, etc. But the builders
and
are
lower
really
rates,
nervous.
because in 2020 and 2021, it was such low rates.
Yeah, exactly. And that's why housing starts were so high. But I do think that as rates drop, you'll see housing starts pick up again. But I've always said the builders are psychic. They're always ahead of me. They're always doing this before I think I would have done it, and they're usually right, and I'm usually wrong just on the timing. So they have some sort of a crystal ball, and I can't answer why, unfortunately, but it's real. That's what's happening right now.
Cool. So we got about 9
Anything
minutes,
else?
Dan. What do you want to make sure you communicate before we run out of time?
Well, I'll get the slides to you. So anything, if you guys want it, it'll be in those slides. And if you have any other questions, I'd love to answer them. And if not, Dave, I don't love to pitch things, but we're doing something new that I'm just really, really excited about.
Well, let's make sure we have time for that. I do want to know what, and you and I had a text back and forth on the guy from The Big Short, is shorting, the S&P. What is you made your prediction from a interest rate standpoint by the end of the year? What's your, S&P or stock market, targets going into the end of the year?
Potential devastation. I think Michael Burry is right. I think I told you when he asked me about that, it was 2 Sundays ago during my weekly video that I said it looked like the stock market was at least temporarily topped out and was going to tumble, and it's done nothing but that. Then this last Sunday, I said, I think it still has room to fall, and it's done nothing but that. So all the reasons that I believe will take down interest rates lower are also going to have a very bad toll on the stock market. Stock market is in la la land. Like, what are they even happy about? Again, back to lowest savings rate ever and highest credit card debt ever, and yet the stock market is rolling. We're starting to see companies now reforecast earnings slightly down, and if I'm right about GDP, then the stock market's not going to be very great at the end of the year. I'm a little bit bearish. I'm not necessarily major crash, get out, but be prepared for a pretty good pullback.
Okay, cool. All right. Well, let's do make sure everybody is aware of, market mentorship and anything else. If anyone wants to, have access to Dan's wisdom and charts on a daily basis, like really be a market master, someone that really knows things. And if, Dan also has some trading communities. My son, Jack, is gone through your training. He says it's awesome. And I've got just countless people I know. So Dan, tell us all the ways people can go deeper with you, whether it's in stock or, market mentorship.
Okay, thanks, Dave. So just first of all, this is just results every week. Every Sunday night I put out a video and I give 6 stock picks. And by the way, this was a short pick. This is the one that this was August 16th last week. Yeah. And I felt like things were going to continue to fall. Well, this pick actually was on the 9th. And you can see that had you purchased the SPY put, it was a 32% gain in 5 days. But over the last 90 weeks, 222% return, 317 wins, 47 losses. Super proud of that. That's our Sunday night picks. But what I really want to talk about today, Dave knows this, for a long time, I've been trying to get a trading bot that I could trust. And we've come out with a pretty incredible bot, and we tested the heck out of it. And this is real. So we actually have 3 bots now. Was our first one, Fusion FX trading bot. It's averaged between 10 and 100% monthly returns. And this information comes from a site called myfxbook.com. And our accounts are hooked up to myfxbook.com and pumped directly into them. These numbers cannot be fudged, changed in any way, shape, or form. So our Fusion bot since February is up 497%. And that's daily, makes about 1%. And where's my win rate? I think maybe, yep. So this doesn't have my win rate, but you can see every single month. This was just half of August when I did this. I think August is going to come in probably well over 20%. And I mentioned this is third-party verifiable results. Monthly average 55%. And drawdown, that means how much did the bot go upside down at any given time? Only 15.8%. In our industry, this is considered very low. And I can tell you that when it did have its dips, it dipped from already being profitable. So it never actually drew down your capital. So this bot's made $26,000 profit. And at this point, this was over a 5-month period.
That's amazing.
Just some yeah.
So if anybody wants to
testimonials,
what website did they
learn more? Did we get this on our new website? Probably send me a note, Dan at universityofoptions.com, and I'll get them to one of our guys, one of our traders. They really talk about the specifics and answer any questions that somebody may have. But I was going to show you just in real time, our latest bot just hooked it up. This one I started August 21st. This is our new Pro FX bot, and it's making 2% a day. Now, it hasn't been a long time, but my point is this stuff is really real. This win rate of 82%. I don't touch it. Literally, and we do the whole white glove installation. We set it up for you, turn it on, and you just leave it alone. So yeah, best probably just reach out to me, and then I'll refer them to one of our sales teams. And then of course we have our University of Options program, which that's where this is the program that Jack is in, and this has just really been going well. Let me see. Hopefully this thing is updated. It should. This also, we feed all of our trades into this. This is options trading. This is not, set it and forget it situation. But these are our actual trades. Every single trade is tracked every single day. And over the last 1,145 trades, we have an 88% win rate. Like yesterday, 10 for 10. This month, only 10 losses. So I'm just super excited about what we're doing. This came from, I would say I lucked into it, but it was the creation of Flight Station, which is an indicator that it just gets it right. So we trade in a live trading room with all of our members every day. And we say when we're going in and they follow us. Make sense? And then one more thing. Sorry, I know this is a lot. This is our new futures bot. This bot, when I just mentioned Flight Station, that we've been manually trading for a long time now, I finally automated it. So Flight Station now trades automatically. Just turn it on. This is today, $3,146. And I have crazy amount of just screenshots, all during the day. I just take these screenshots. I think this thing's only had 2 losing days in the last maybe 20. So yeah, we're doing some cool stuff. If you want to learn more about it, reach out. I know that was a really long pitch for me. I typically try not to do that much, but I'm
You got
really
a lot to
excited.
share, and you got a lot of new things going, and I'm just super grateful for the daily updates and for coming in. Deborah, any closing thoughts or any taking action things for Dan?
Well, if rates do come down that quickly by the end of the year and we have people lining up and it gets to that level of competition, then I would say for those listening on the call, how prepared are you at helping your clients win in that competitive of a market for when rates do come down? And then also, I just wanted to share this post as a little takeaway. This was on the Win by Noon channel this week. And it says, people don't follow, it's by Donald Miller. People don't follow the best leaders. They follow the ones they can understand the easiest. So how are you in an advice-driven era? How are you teaching and educating and equipping your clients and agent partners where it's content that's easy to understand so that they will follow you in times of markets like today?
Is that a question, by the way, or you just throw that out?
No, that it was just, I was leaving that out there for
Oh,
you guys to
Yeah,
thoughtful
kind of
thoughts.
got it. Hey, I do
Yeah.
want to let folks know I interviewed JJ Peterson this week, and that was released on our YouTube channel. He is the head of Story Brand and the co-author with Donald Miller of Marketing Made Simple. So check it out. Dan, I see you have some things on your screen. Was there one last thought you wanted to share before you stop sharing your screen?
No, I think we covered it all.
Okay, I saw you moving your screen around. I didn't know if you had something. I want to.
I was looking for something, yeah, but I didn't find it. Sorry.
All right. Well, we are going to wrap this up within a minute. I do want to remind folks that for this entire month, we're doing the Mortgage Coach 10X training. Shayla Gifford is this Tuesday at 9 Pacific. We're going to really focus on how, as an advisor, she's winning with both realtors and builders. Like, new home construction is a much larger percentage of the home sales than it typically is. So builders are important, guys. Don't miss this. Also, just a reminder, if you go to Mortgage Coach 10X, this is my 10X for all this content. If it's green, go learn how to reduce price exceptions and win with rate shoppers with Jeremy. That's available. And, this whole training, and I'm going to continue it for the month of September. So check it out. Well, Mr. Rawitch, dude, it's been too long. We got to catch up on a personal note soon, and let's do that, brother.
Yeah, I want to come see you out in Newport Beach and check out your crib. And I miss that area already.
Anytime you're in town, I can't wait to see you.
You loving it still?
Oh yeah, no, life is good. We're loving it, and can't wait to have you down here. And who knows, I might see you up in your neck of the woods too. So let's see each other soon.
That'd be fun.
All right, guys, we're going to wrap this up. Everybody have an awesome day, killer weekend. Shayla Gifford on Monday. Hopefully you got a lot of value. If you do take any of this content and you use it as realtor education, use it as borrower education, give us a tag, Trust Engine, Mortgage Coach, Dan Rawitch, tag us on social media. Take care, everybody.